market shift. That one applies for both. Swing market shift SMS. Have the swing market shift. So this one applies for both. You can have it here, you can have it here, both in the bearish market and the bullish market. This will show you that what price or the direction of the market is changing, or the trend is changing in the market. Aside that, we also have the stop hands. Stop hands. Also both bullish market and bearish market. So guys, these are the short hands that you need, or that we'll be using along the way. So you can have a screenshot of it, or you can quickly note it down and continue. So when it comes to the theory aspect, this is it for what? For liquidity. I said what liquidity is defined by stop losses, where the stop losses exist, and what is where the liquidity also exists. So where the stop loss is where liquidity is. Are you getting it? That's the simplest what meaning I can give you. Where the stop loss of retail traders is where liquidity lies. So the banks manipulate the price because of liquidity. So whenever you see a manipulation in the market, it's because they want to take liquidity out of the market. So sometimes you ask yourself, why does that happen, or why do liquidity happen in the market? So it's simply because the banks negotiate with large trading volumes, and sometimes find it difficult to find the other side of their positions or their trades. So they manipulate the price, and they can find their positions in the market. They manipulate the price so that they can find out position in the market. Right, so right now you can move to what the chart for. So we start from the buy stop liquidity. Okay, so when it comes to the buy stop liquidity, I said it's what is originated by stop losses of all sales orders. So what happens is they will first take out what the sellers in the market. So they will first take out the sell orders over here for price versus to the downside. And when it comes to the sell stop liquidity, is also what the vice versa of this. We have this price move to the opposite side. So this is where basically the institutions, the entries will be over here. Right, so after something like this, then we start having what a swing shift in the market. So you can see price will start forming what lower highs and lower lows in the market. Then over here too, price will start forming what high highs and high lows in the market. Okay, so let's look for example over here. Let's start from, we have the previous monthly high, so you can start from the monthly time frame. Okay, so over here you can see this what the previous monthly high. Get it? So it's serving as what a liquidity target for the institutions. So they are targeting what buys in the market. So you can see it took out this liquidity, brought price down, targeted here again, took it, price came down, formed what equal highs over here, which serve as one liquidity also. Price went up, took this liquidity. You can see price came down again. So this is how what to identify previous monthly high. So it doesn't necessarily mean we should look for accumulation of what candles or past history. It can be only one candle because we are on the monthly time frame. So when we talk of previous monthly high, it can be what a single candle. I get it. It can be a single candle. Alright, so over here too, you can see what happened. This candle got liquidated. It's not that clear, but I can see what this bearish candle took liquidity from this bullish candle. You can see it took out the liquidity what's above this previous monthly high, and it's sold all the way to the downside. I get that. So we said what whenever a buy stop liquidity is taken, price reverses to the opposite direction. So you can see when price took out this previous monthly high, you can see price then what reverses to the downside. Over here too, you can see this one is the previous monthly high. You can see what this bearish candle took out liquidity and dropped. Over here too, you can see same thing over here. Price took out and dropped. Same thing over here. Price took out and dropped. You get it? Over here too, you can see price took this monthly high, started dropping all the way to the downside. Over here too, you can see the same thing. So this is what how to identify what the previous monthly high. It doesn't mean you should look for what the whole formation of a candle or a pattern before you be able to identify what the high and low of a candle. You can just use one candle to identify this. All right, and we then move towards the previous weekly high. So when it comes to the previous weekly height, you can see over here that was we just target what the previous highs in the market. So this is the previous high, and price took it out and drop. I get it. That's if you are using what accumulation of the weekly candle, but each candle over here stands for what a week. I get it. Each candle over here stands for what a week. Right. So over here too, you can see price took out this previous weekly high and dropped. Previous weekly high and drop. Then over here too, you can see price took out this previous weekly high and drop. You get it? So you can even use it as what to identify the direction of a trend or where liquidity lies in the market. So that's it for the previous weekly highs. and then we move to the previous day high. Right guys, so we have like 1 minute for this zone, and then you guys can rejoin the same link. Okay, so you can have all this as what previous day high. Let's took it. So now this also becomes another liquidity target. Price took it. I get it. Then this place again. Price took it and drop. So this becomes what as a break of structure for you. Then you can see over here what it started forming lower highs and lower low. Over here, price change what started forming what previous what day low. So previous day low. You can see price started taking out previous lows in the market. Price started taking lows in the market. So guys, we have like 1 minute. I think I'll have to pause this